The paper is a joint paper, of course with a bit of specialization, Morris having contributed a lot not only on the US but on the policy framework in general. All the good things in the paper come from him, all the shortcomings come from me. And I also must apologize to start with the fact that this, as you already see from the title, this paper concentrates on a very limited part, but very important part, of the debate. Mario Draghi just told us that too big to fail is perhaps the most challenging remaining legacy of the crisis. Certainly it's a topical issue at this moment, an important one, and also one which we thought that it would be appropriate in the context of this conference, because this is an issue where, as I will try to explain, there are differences which are significant between the US and the European Union. Some of you may have picked the paper on the table outside. I should insist that this is a draft paper, it's not the final version, and we look forward to collecting feedback from this discussion and from other consultations to prepare the final version. Finally, I should say as a sort of background, and I won't come back to this in my presentation, that in all financial regulatory matters, when we compare Europe and the US in terms of reaction to the crisis, we should never forget that we have different timetables there. The US arguably has largely put the banking crisis, not the economic crisis, but the banking crisis behind themselves. It's not the case in Europe. We still have a banking crisis in Europe. It's not resolved. And this has also an impact on the timetable of the regulatory response. The US now, with the adoption of Dodd-Frank, has set a framework. Of course, lots of work still to be done by regulators, but set a framework of its legislative response to the crisis. We are not yet there in Europe. So basically, this difference of timetable is important. Now, the too big to fail issue is something that's not new. Actually, the expression applied to banking dates from the US debates in the 1980s, especially the failure of Continental Illinois in 1984, I think. But it's been put under the spotlight with this crisis as a sort of three-pronged major policy challenge. It's a challenge in terms of systemic risk, because if institutions are too big to fail, they will be incentivized to take more risk than is appropriate because of the sense of vulnerabilities that their too big to fail status gives them. It's a challenge in terms of competitive distortions, because there are now a number of empirical studies that tend to confirm the intuition that very large, too big to fail financial institutions get cheaper funding than institutions that could be allowed to fail. And it also is a political challenge, because the very notion of too big to fail financial institution contradicts an essential tenet of capitalism, which is that if you fail, you fail. Bankruptcy is here to sanction failure. And if bankruptcy is not an option, as some people have said, it's a bit like Christianism without hell, or Christianism perhaps without the final judgment, and it does have political impact, because people start to question the fairness of the system. If some actors, specific actors, people who, by the way, earn a good life, are protected from the general principle of accountability. So here at the Institute, Simon Johnson, together with his co-author James Quack, has insisted on this a lot. It's made even more of a challenge by the fact that the banking sector has been on a general trend of concentration, and this has been accelerated by the crisis. The very simplistic graph that you get here is the share of the largest 10 banks in the world as a share of the total 1,000 banks in the world by assets, and you see that the concentration has been on an upward trend before the crisis, but has been accelerated sharply. There's an ongoing policy discussion. There will be an FSB report for the Seoul Summit. Mario Draghi just said that. What we have tried to look at in the paper is the differences between the European Union and the United States. And here, a lot of the differences go back quite far back in history. The distrust of large financial institutions is ingrained in the US political fabric, and perhaps started with the famous quarrel between Hamilton and Jefferson in 1791 for the establishment of the first bank of the United States, certainly was illustrated at several times in US history, and particularly in the financial repression, let's call it that way, legislation of the 1930s, actually even of the 1920s. Legislation that prevents banks to branch in different states dates from, I think, 1926 or 27. This legislation was largely reversed in the 1980s and 1990s, but it still shapes public perceptions of banks in the US, and actually the distinction between commercial banks and investment banks is still very much in mind in the US to an extent that has no equivalent in Europe. The too big to fail debate itself is not new. Continental Illinois, I mentioned, was explicitly not allowed to fail by federal authorities in 1984. Then there was also not too big but too interconnected to fail LTCM, the LTCM rescue in 1998, coordinated by the New York Fed. And Continental Illinois was a big reason why Congress passed the Federal Deposit Insurance Corporation Improvement Act of 1991, which created the resolution authority for commercial banks as we know it until Dodd-Frank in the United States. In the EU, this story is perhaps less known here in the US, but also in the EU. I think in the EU, many people consider all these historical differences as implicit, but they haven't perhaps been sufficiently emphasized in the public debate. Well, first we have a big component of support to national banking champions, which comes simply from the fact that the EU is a union of different countries, and the countries have tended to compete, including with mercantilist strategies throughout their history, and this goes back very far in time. There has been a lot of cross-border banking M&A in the late 90s, early 2000s, so now we have a couple of groups in the EU which can really be considered pan-European financial institutions or pan-European banks. Santander, BNP Paribas, UniCredit, or others come to mind. But still, the structure of the banking system is still very much national with, and that's what's important for our purposes here, an intent of the different governments to basically protect or foster banking champions. Of course, it varies from country to country, and this is certainly mostly the case for the large continental European, Western European, perhaps I should say, countries. Very important in the EU is the fear of the political and social consequences of bank insolvencies. One particularly revealing anecdote is when IKB, which was a fairly small bank in Germany, was on the verge of collapsing in 2007. The senior financial regulator in Germany, Jochen Zernio, said, well, we have to bail it out to avoid the worst financial crisis since 1931, and in the German psyche, I don't have to explain why the banking crisis of 1931 is an important reference. We also have a big legacy of public unlisted banks. There have been large-scale privatizations in the 1980s and 90s, so you don't have that many big commercial banks which are state-owned in Europe anymore. There are a few remaining ones, for example in Poland, PKO Bank Polski, but these are exceptions rather than the rule. However, you do have a lot of unlisted, generally local banks, some of them fairly big, or agglomerated in national groups, which are not subject to the same sort of corporate governance and accountability and disclosure requirements as listed commercial banks. And these are typically the savings banks or also the Landesbanken, which are a special case in Germany, but also savings banks or cooperative banks all around Europe. Rabobank is very big in the Netherlands, etc. And generally, when they stay local, these banks are actually very resilient and stable. They have a strong local business model, but it becomes very different when they try to expand into other business areas, and this has been a factor of instability in some cases. Finally, very important difference, which is not always completely acknowledged in Europe, is that actually in Europe we don't have a too big to fail problem. We have a forbidden to fail problem. No single significant bank has been allowed to fail on its obligations vis-à-vis creditors. So far, the only exception we found is DSB Bank in the Netherlands. You probably haven't heard of it if you're not Dutch, and that's because it's a relatively small bank. But basically all the examples you have in mind are examples where no creditor has lost any money. of course, shareholders have lost money, but even preferred shares and subordinated debt have been basically taken over in terms of obligations by the taxpayer. And that's a big difference with the US, where there are a number of examples, starting with Lehman, of course, but not only Lehman, where at least in the small bank category, banks have been allowed to fail, basically. Differences, I've already hinted at that. These differences translate into big differences in financial system structure. And here I'll be very quick, because you know all that. In Europe, banks are much bigger in terms of the share of total credit intermediation. In the euro area, no less than 74%, according to the IF, of credit intermediation is through banks. In the US, it's only 24%. And conversely, there are no large non-banks in Europe, apart from insurance companies, of course, but you don't have a big independent non-banking group that can compete with the banks in terms of size and systemic importance, whereby you do have them in the US. Also, as compared to GDP, European banking systems are much, much more concentrated or more bigger in terms of the share of the top bank's assets to GDP. You see some numbers here. Courtesy of Philip Turner at the BIS, whom I want to thank particularly for having helped us with these numbers. You can see that basically all important European countries are enormously more concentrated than is the US, even after the very significant increase in concentration in the US in the past few years, and especially since the beginning of the crisis. So basically that means that the too big to fail problem in individual European countries is both vastly bigger than in the US and also, as a consequence, vastly more intractable. Of course, there are additional differences in terms of cross-border linkages. I've mentioned the fact that there has been cross-border M&A in Europe. Many banks have non-domestic activity, which is the typical large European bank has less than half of its activity in the home country, actually. So basically, it's massive when compared with the US, where this proportion will be somewhere between 3/4 and 4/5 of activity in the US for the largest banks. And that means that also, as Mario Draghi has hinted at, when there is a big bank failure, you have to manage all the cross-border spillovers, which makes it extraordinarily difficult. One thing that perhaps some of the Europeans will react to in this table is that this is measured against national GDP, not European GDP, or EU GDP, or Euro area GDP. It does make sense to look at it this way, because we've have had it confirmed through the crisis that the backstop for banks is at national level and not at European or Euro area level. So if you think of liquidity policy, of course, this doesn't apply. But if you think of bailouts and what we try to address in the too big to fail debate, at this point, unfortunately, many of us would think the right thing to look at is the relationship to national GDP, not European GDP. So what about the policy debate? Basically, to sort of organize the discussion, Maurice and I decided to say, well, too big to fail is basically about too big and it's about to fail. So you have a number of policy recommendations which are aimed at addressing the fact that some banks are very big and that this size issue creates a potential for the too big to fail problem. And then there are a number of other proposals which are aimed at making failure more of a credible possibility than it currently is. Of course, there are many problems of definition. We have a discussion in the paper, I'm not going to dwell on this, on how to define systemically important financial institutions. It's actually not that big a problem, even so there is a lot of technical discussion on this. One important question is, if you do create a specific policy framework for SIFIs, for systemically important financial institutions, there is a question of whether you want to make the list of such institutions public, and this has generated some controversy. We think that it's inevitable. If you do have a specific policy framework for SIFIs, you do have to make it known to the marketplace, and it's actually not that problematic because some people say, well, it will entrench their too big to fail status, but we argue that if they're that big, they're already entrenched as too big to fail institution, and the fact of recognizing their systemic importance is not that disruptive. Actually, interestingly, one European country has already published such a list, that's Belgium, and it didn't create too much disruption so far. Interestingly, Belgium has included in the list of locally systemically important institutions the local operations of some US or foreign banks. I'm out of time. I'll try to be very quick on the rest. So basically, you do have the possibility of addressing this bigness problem through curbs and incentives, through capital surcharges. Mario Draghi mentioned it. There is one example already in Switzerland, through taxes and levies by making them bigger, more heavy in case of SIFIs, and there's an example now in Germany, or by competition policy, which in the European context is a very important instrument, by curbing mergers or forcing financial institutions to divest operations in case they are becoming too big. And then there are a number of proposals that are more radical in terms of size caps, breakups, and there are debates about whether it should be an absolute size cap, say $100 billion as Simon Johnson has proposed, or relative to GDP. And in the European context, none of these solutions is really attractive and feasible politically, we think. So we think this is very problematic in an international context. It's controversial in the US, but it becomes much more controversial when you look at it internationally, even so some of us may think that there could be an economic rationale for that. Actually, there's also controversy on the economic justification because we don't know that much about the economic benefits or costs of size and economies of size and scope in banking. There's an alternative, which is to have an emphasis on critical market functions. For example, repo clearing, where actually this function of clearing repo trades is extraordinarily concentrated globally, and maybe you should look at different functions and tackle the concentration. In Europe, I've already mentioned the debate about national versus EU reference. Of course, everything is easier in Europe if you can look at an EU reference for the size typically measured by assets to GDP, but that would mean a big change in the policy framework to have a really integrated policy framework at EU level, which we currently don't have in spite of the progress that has been made, especially with the recent creation of European supervisory authorities. The other set of proposals is what we call with a horrible neologism, failability debate. How can failure be made more credible? Basically, Mario Draghi has presented these different options: special resolution regimes, or resolution authority, Dodd-Frank Act in the US, in the EU, different national frameworks, and also the role of competition authorities, which has been proven very important in the crisis, and living wills or orderly wind-down plans, which are being developed, where, of course, for lack of time, I won't develop how difficult it can be in the EU to address the role of host countries, but this is addressed in the paper. And finally, contingent capital and bail-ins, and here I can only echo what Mario Draghi, I think, very accurately says. This is very attractive, but essentially untested, so it's too early to know whether it's a realistic proposition in the context of prudential policy. Conclusion. We think it's not realistic to think that policy can eradicate the too-big-to-fail problem. It's something we have to live with, like corruption, illness, and dishonesty. But it's something that we would like not to have to live with. But progress can be made, as in the other problems I just mentioned. And we think that a number of the solutions that are here, some are more radical than others, but they're worth pursuing and they have to be pursued by policymakers. So basically, we end up supporting the efforts that are made at global level, even if we highlight the extent to which they will be difficult to operationalize and transform into concrete policies. Thank you very much.
Thank you. I'm somewhat puzzled by the comparison between size and dishonesty, because I thought that size was more visible than dishonesty. But let's perhaps that's something to address in the panel. We start with Anil Kashyap, who I understand has a PowerPoint, so we'll speak first from here, and then we all go to the table, because the other presenters don't have it. Anil is a professor at Chicago, well known for research in this field, also a specialist of Japan, which is always useful to have as a background to address those kind of issues.
Thank you. That's okay. I can start talking for a second. So thank you. It was a pleasure to read this paper. It's actually quite good, and I encourage you to read it. I'm going to teach it to my students next year, so that's the highest endorsement. You didn't announce my affiliation, but I will announce that I'm at the University of Chicago Booth School of Business. I point that out because during the crisis, the only institution in the world that raised enough capital was us. And all it cost us was changing our name. So I think you could compel people to raise capital, and it works. And that's going to be a theme. So they're going to put some slides up here, I hope in a second. Let me say, in the course of the discussion here, I took seriously the instructions that we were only supposed to have 3 slides and we were only supposed to talk for 10 minutes. So I'm going to hit both those targets, and that means that I'm going to pass on a number of things that were in the paper. So I'm not going to talk at all about this discussion of who is too big to fail and whether you should disclose their identities, whether these size caps might work, where the origins of the differences between the U.S. and Europe came from. But I think the discussions there are good, and I certainly broadly agree with the big thrust of the paper, which is that, too big to fail is a serious problem, but it's probably worse in the European context. I'd never really thought about that, but I think they make a pretty compelling case that Europe is going to have a more difficult time with this than the U.S. So I think that's the first big takeaway from this paper. And there's a lot of good numbers in the paper, too, that are just interesting comparisons over time and across the Atlantic that I think you'll enjoy reading. So I don't know, go to the next slide. I have one major kind of nit to pick with the paper, and that has to do with that has to do with really the dynamics of what goes on with too big to fail and why we should be worried about it. Most of the discussion in the paper reads as if the problem is the company's going to fail, and when it does, it's going to take down a bunch of counterparties through a sequence of cascading defaults. And I don't really think that's what we're worried about, because what you see as one of these firms gets into trouble is that their debt maturity starts to adjust, and you find that the debt maturity is shortening, and it's not accidental. These creditors don't really understand necessarily what the officials are going to do if the firm really gets into trouble, so they start lending on a shorter and shorter basis. And what you find is when you get into the actual end stage of a crisis, what kills you is the run, both through the short-term creditors and through the derivatives book. And then what we learned in this crisis that I don't think we'd appreciated much, and Mario cited it when he was talking, was the fire sale that comes once the run has begun and people start dumping assets. And really that's the dynamic that we need to deal with if you take as given that we don't really have all the tools for a good resolution regime. So I think you can't really separate too big to fail from the kind of uncontrolled destruction that happens once a run begins and once the asset dumping proceeds. And so I really think you have to think of the challenge here is figuring out a way to try and manage that. And in that sense, I'll say Dodd-Frank is pretty bad, because Dodd-Frank was a combination of let's try to straighten out what happened, but let's punish the bastards. And so there's conflicting tension all through the legislation, and you see it quite clearly with respect to this runs question. So because they wanted to be able to impose losses, there's this idea that you should have a one-day stay, where you would have 1 day to wind down the derivatives books and maybe not pay everybody off in full. But of course, the fact that the people see that 1 day stay as doom is approaching means they're going to run. So I think in equilibrium, you've accelerated the run. Another example of the let's get even with these guys. The clawback provisions in Dodd-Frank say that there's the possibility if a settlement is made that after the fact, if it turns out that you got paid more than you would have in liquidation, the Treasury can come after you. And then there'll probably be lawsuits by other counterparties that didn't get as good a deal as they should have that will force the Treasury to come after you. That's going to, again, accelerate the incentive to run. So you're going to have these incentives, and I think, you know, Dodd-Frank, despite all its good intentions, really didn't confront this is what we have to manage. So I think when we come to thinking about this, we need to focus more on controlling the runs. And I would say, even if you round up, you know, the leading thinkers in the world and said, okay, design the resolution authority that you need to deal with this, it's not obvious what you would do. It's just a really hard problem. So I'm part of this Squam Lake group, and we opined on all kinds of stuff. We couldn't figure out what to say about this because it wasn't obvious how to manage the various trade-offs, but I think it's a problem we have to deal with. Okay, so all right, so with that in mind, Mario teed up exactly where I want to end, which is, given that we don't really have a great way to resolve one of these firms, and we've got all these cross-border things that he talked about, we need to be thinking about contractual ways to the extent we can to manage this. And here I think one of the principles he's mentioned about internalizing losses is a great way to do it. So the paper talks about taxing size through higher capital charges and higher liquidity requirements. Mario emphasized that too. I think those are great preventive measures, and we should be looking in that direction to the extent we can. But I think in the end it's probably not going to work, and you're probably going to face one of these institutions that's failing again. And so to that extent, I think you need to figure out ways to get capital in. Mario mentioned bail-in. There's a page in the paper on this. I think that's probably something that deserves more attention. The bail-in idea is that you would contractually write into the contract structure rules that say, as you get very close to failure, everybody's going to convert in the following cascade of ways. So the equity holders are going to get wiped out. Subordinated debt's going to turn into warrants or something like that. Slightly more senior debt is going to convert into equities, and it's going to go all the way through. The people at Credit Suisse have been pushing this very, very aggressively. It turns out that Swiss law seems to permit you to actually implement this type of thing almost as is. So short of getting harmonization of all the bankruptcy code, if we could just get an arrangement so that you would respect the agreements across jurisdictions on this kind of a bail-in thing, I think this is a very appealing area to pursue. And one of the things that market participants will tell you about this is there's a lot of discretion that happens if you actually go into bankruptcy or if you're lurching towards nationalization. Having it written out and having the loss-sharing rules pre-contracted makes it much easier for people to assess their risk. It looks like the kind of thing that people in financial markets price all the time. They're used to pricing losses and credit events, and that's what this would turn it into. And it has the advantage that if you do it on a huge scale, you would make the institution on the backside incredibly well capitalized, which then creates incentives so that people don't have to run. If they're going to be the best capitalized bank in the world the day after the triggers are hit, you're going to continue doing business with them. So you can do that. You can do a version that's contingent convertibles. If you do it on a big scale, it would look very similar. I think either of those things are good. And then the last idea I would pitch, I think my favorite Squam Lake idea that hasn't been picked up at all, is to force the bankers to hold back some of their bonus pool. Imagine that they held back 20% a year for 5 years. So you'd have 1 year's worth of bonus pool sitting there. That would change the attention of the people deciding whether or not they want to raise capital. If they knew that everybody in the firm was going to use essentially, a year's worth of bonus, it would be a huge amount of money that could be sitting there that could be invested in contingent convertibles if you want to jumpstart the market so that you force some natural buyers, you get some price discovery, and you align incentives. So I think options like this are probably the thing that I would change most about the paper is to beef up this discussion. But thank you.
there are an awful lot of papers that aren't quite about the right subject and are slightly, if not orthogonal, at an angle to what's actually going on in the policy world. This isn't one of those papers. I've got 4 remarks on resolution, but let me start with a comment on the comparison between the EU and the US. And first of all, I think one of the great things about today and about this paper is making that comparison. I think you overdo it a bit. So let me give you 2 examples. The statistic that credit intermediation in the US is only 24% in the banking industry. It's surely more when you build in that part of the so-called shadow banking industry, which was utterly dependent on committed credit lines from banks. If you add that in, I think you'll get a bigger number. And it's why what's been going on since has been, in part, re-intermediation, including, sadly, onto central bank balance sheets. The second thing I'd say about that is that you, for understandable reasons, and at its core this is right, you draw a distinction between the kind of capital markets-oriented investment banking in the US and the rather more traditional commercial banking tradition in Europe. Yet, let's face it, the losses on both sides of the Atlantic came from carry trades. These weren't great big trading positions. These were, on this side of the Atlantic as well, investment banks and universal banks borrowing short to lend long for a credit spread and holding it for a while. Sometimes describing them as warehouses, but you know, all of that was part of the smoke screen. So I think you need to moderate some of the comparisons you make. That doesn't matter at all to the core of the argument. The core of the argument you make is that too big to fail is at the core of this. As Mario said, we, the official community, most certainly think that. And I speak not only as somebody from the Bank of England, but as the chair of the FSB's working group on resolution. And I'd make 4 points about that. The first is it's striking, it's shocking really, the extent to which so many countries in the world, including my own, didn't have a bog standard resolution regime for bog standard commercial banks. And I think this goes partly to the comparison you make between Europe and the States. What tools you have not only reflect your thinking and your culture, they actually influence your thinking and your culture over time as well. If you don't have any tools for resolving commercial banks, and if you're completely unfamiliar with them, then you're conditioned over many years and decades to thinking that the only thing you can do is to bail out the bank if it gets into difficulty. Now, what's happening in Europe now, and I mean within the EU, is it seems very likely that the European Commission will bring forward proposals that a standard resolution regime is introduced in every country of the Union. We've already done this in the UK. That's the legacy of our Northern Rock experience. But this will, I think this is quite likely to happen in Europe, and I think that it will affect the conversation, the policy debate about this a lot. That there are officials all around the world who, when you try to talk to them about resolution, after about 10 minutes, they start talking about supervision and early intervention and capital ratios because they're unfamiliar with what resolution is. And of course, when we equip ourselves all with a basic resolution regime, I think the policy debate will be enhanced. I'll come back to that. The basic resolution tools that were developed in this country and in Canada as well don't work for the giant, most complex international firms. In one respect, that's because they only apply to commercial banks, didn't apply to bank holding companies, didn't apply to affiliates, didn't apply to dealers or insurance companies. And at its root, that is what the Dodd-Frank resolution regime does. It extends the basic toolkit to other types of financial institution. That's an unambiguously good thing. The other thing that it does, and Anil touched on one aspect of this, is that it closes down the practical possibility and concept of open bank resolution. And it does this because it identified open bank resolution with state bailout, which I think is a mistake. I don't think the two are the same thing. And this is quite important for what I'm going to go on to say, which is about bail-in. Anil's talked about the contractual version of bail-in, in which we in the FSB see great merit, and there'll be further work on this going into next year. But there's also a resolution version of bail-in, and these two things aren't mutually exclusive at all. If anything, they're reinforcing. And think about resolution as when you're in the last chance saloon, and enhanced supervision has failed, higher capital ratios have failed, all the COCOs and contractual bail-in bonds have been triggered, and it still wasn't enough, and you've got an insolvent or incipiently insolvent bank or dealer on your hands, and you're sitting in this room, and I've sat in rooms like this, and you have, without some tools, you've got two choices. You've got go to the political leaders and say, can I have a load of money to spend on a bank to rescue it, or alternatively close it and get mayhem. And no one should have been surprised that the closure of Lehman was mayhem. That much was obviously foreseeable. So the resolution debate is about what tools you can have in those circumstances. And the Dodd-Frank tool says, I will take this giant and I'll put it in a bridge company, and I think that can work where there are buyers for bits of the bits of the underlying business. So Barclays and Nomura in the case of Lehman. It's a more hazardous enterprise if there aren't immediately buyers, because there you are, a government agency, and you are left owning and running Lehman the following morning for weeks. And I suspect people stop going to work, and I suspect that even if it's risk-free, some counterparties will move away, because what's the point of dealing or placing money with an institution which has no future? But there are definitely circumstances in which this could work, and I hope very much that we put it on the statute book in other countries. The bail-in resolution tool could also only work probably in one set of circumstances. And so take a group which has 20 lines of business, and they're all equally the same size, and it's 20 times levered as well. And one of these lines of business is completely toxic. It's worthless. This business is bankrupt. But its franchise, in 95% of its business, is fine. It's just got a completely screwed up capital structure. We're familiar with this in this country from Chapter 11, and what Chapter 11 does is it reconstructs the capital structure. It writes off the equity, writes off any subordinated debt, and it eats into senior unsecured, in banking's case, uninsured debt, and then converts part of the residual into equity to recapitalize the bank. And this is the resolution form of bail-in, and that too, like the contractual form, is likely to be studied around the world over the next year or so. And it's probably not essential that everybody has exactly the same set of tools. My third point is about cross-border resolution, because everything I've said up to now would apply if there was only one country in the world, or alternatively, say JP Morgan Chase did all of its business within this country. It's still pretty difficult to resolve it. Once you get the cross-border element, it's much more complicated for the reasons that Mario said. And what this comes down to isn't just a technocratic problem, which people on my group and the steering committee of the FSB can solve. There's something about sovereignty here. Are we going to get, it's probably unrealistic to expect a multilateral binding treaty that determines that there's one lead resolver for these firms around the globe. Nor, on the other hand, can we expect countries to unilaterally disarm, where they say, well, I'll let the whole home country lead come what may, even if they take no interest in my circumstances at all. But that doesn't mean we can't do useful things. We can, as Mario said, we can remove automatic triggers, where if I do something in the UK, it automatically triggers bankruptcy elsewhere in the world. or ring fencing elsewhere in the world. And we could remove legal impediments to cooperation because they exist in some jurisdictions, and we could even introduce exaltations to cooperate, take account of the host country's circumstances. And remember that there are some big banks around the world headquartered in one country, don't have much business there, have a lot of business in other countries. This is going to require political will and actually a political steer before we can make more technocratic process. And the final thing I would say is about living wills, which, by the way, I think the expression living wills was probably popularized by my boss, Mervyn King, after a discussion he had had with Anil. And I can remember Anil saying to me, shall I discuss the living will thing with Mervyn? And I said, yeah, do. And Mervyn gave a speech about it, and it's helped give the whole idea currency. The point I want to make, though, is that what a recovery and resolution plan looks like varies according to the resolution regimes that you have. If you don't have a decent resolution regime, there is no resolution plan to be written. People can fill files with papers, and by God they are, but actually it doesn't amount to a plan that would help you resolve the bank. It means you might have a recovery plan, but not a resolution plan. So what this living will thing is going to amount to will depend entirely on two things. First of all, putting in place the statutory frameworks along the broad lines I've described, and secondly, and separately, a preparedness for much more candour and openness in exchanges between home and host authorities, on which note I'll change. This was a nice paper, and as I say, very much about the right subject. Thank you.
Thank you very much, Paul. Our last discussant is Victor Gao, who is the Executive Director of the Beijing Private Equity Association. I cannot resist to say that in the previous life he was also a collaborator to Deng Xiaoping.
Thank you very much, Mr. Chairman. Ladies and gentlemen, it is a great honor for me to be invited here to attend this very important meeting and to be amongst with all these big brains. And I'm sure I will go to pick many of these big brains in the coming years. I have to confess that whenever at an international conference like this, where the focus is about transatlantic, the Chinese normally are very quiet because we hesitate to make a contribution. Fortunately, now 2 of the 3 largest economies in the world are in East Asia. And if you really believe in the projections about India, maybe in a couple of decades, 3 of the 4 largest economies will be in Asia. So that gives me a little bit of a lack of hesitance to make some contributions. And I'm sure that by now few people no longer do not know the reference about too big to fail. But I have to acknowledge that when I was reading this excellent paper, and when I came across too big to fail being abbreviated as 2B2F, I actually had to pause because it reminded me of Hamlet when he asked that fatal question, to be or not to be. That's the major question. Because 2B, 2F sounds like to be or to fail, or to be a 2B, 2F, or to fail as a 2B, 2F. That's the question. When I continued to read the article, I came across references to systematically important financial institutions being abbreviated as SIFI, S-I-F-I. It really looked like these institutions being alien institutions descending on mortal peoples like us in an UFO, and they really kind of took on immortal dimensions like in a sci-fi movie. And it actually is alarming because some of these big financial institutions do claim to be immortal. We remember in the midst of the financial crisis, Goldman actually came out to say what they are doing is God's work. And also it reminds us that just a few weeks ago, again Goldman Sachs came out by threatening to pull their operations out of Europe if the regulations there are to be perceived not by the general public, not by the regulatory community, not by the world as a whole, but by the bank as to be too restrictive. So this is the issue we are faced with. And it also reminds me of a real story, and I want to share with you very quickly. That is, during the Long March in 1934 and 1935, there was a crucial battle. And if the Red Army lost that battle, there will be no new China, there will be no Mao Zedong's Cultural Revolution, there will be no Deng Xiaoping's opening to the outside world, and there will be no big headache about renminbi, of course. But there was a dozen of brave soldiers who overcame all odds and won that battle and paved the way for the founding of the People's Republic, of course. But do you know what they were awarded as a result of their bravery? They were not awarded by gold. There was no gold at the time in the Red Army, not a castle or a big plot of land or treasury bonds or greenbacks. They were issued, legend has it, a certificate of immunity from death. Actually, it was not uncommon because in the imperial days, if you really helped an emperor to found his empire, or you helped an emperor to defend his empire, or you helped one prince to get the throne for him against all the other princes, you sometimes were given a certificate of immunity from death. And do you know what are the consequences in the Chinese historical precedents? Once a mortal gets a certificate of immunity from death, all kinds of evils would happen. And I would say that for an institution to be classified either by itself, which would be even worse, or by the regulatory community as 2B2F is really a recipe for great disasters. And I think we really need to think very, very carefully the profound consequences attaching to that. Now, it also reminds me of a very recent story. That is, around the time 1998, in the midst of the Asian financial crisis, there was a big financial institution in China. It's not a bank, it's a trust and investment company called the Guangdong International Trust and Investment Company, which was so huge, on a par with the bank, actually. It did all kinds of things. And then when the financial crisis came, when the water started to recede, all the liabilities were exposed. And the Chinese government were faced with this critical choice as to whether to shut it down or let it live. And eventually, it was shut down. Do you know what's the consequences? Of course, not only JIDIC, which had a weird name, JIDIC, JIDIC was shut down, but almost 2,000 trust and investment companies eventually had to be restructured. And now there are only about 60 trust and investment companies left. But I think China is a winner out of that huge, painful, traumatic experience, because it taught you that no company, no financial institution should be immune from death. And if there is any Chinese company, state-owned or privately owned, who comes to your attention and claims that he has a certificate of immunity from death, don't trust him, because there is no one, because the Chinese government has learned that while it is their responsibility to protect the interests of the depositors, the interests of the society as a whole, you cannot create this moral hazard of giving anyone, any institution, this certificate of immunity from death. Because otherwise, we will not know what you will take a bite for, because the bite you want to take as a country, or even as EU as a whole, or even as big countries like the United States or China, you do not know what will be there. Many of us believe in the invisible hand of the market and thought that the distinction between the state and the government is a sacred one. Things should be left to the market because it's efficient, because eventually it will sort out all the problems, and eventually shareholders' values will be maximized. But don't forget that the invisible hand of the market may be hijacked by greed. And it's not ordinary greed, it's greed in the most sophisticated form. It's greed as if, they have double calculated both themselves as well as the counterparties. And it is the greed which can really bring havoc, not only to themselves, but to the country they operate in, but also in the financial world, to the whole international financial community. Therefore, I think when we talk about this 2B, 2F, we need to know where are the regulators? What should they do? Do they just need to do and classify which institute is 2B, 2F? Or there is much more for their regulatory job? And also, while the international and global financial market is increasingly becoming an integrated one, the regulatory regimes, the countries, the regions, etc., they are not on the same boat. Even in China, for example, the securities regulators, the insurance regulator, and the banking regulator, sometimes they are very much engaged in a turf war against each other, rather than try to get their acts together to get a regulatory issue done. Therefore, I think it is an uphill struggle. We should not just be complacent that once we designate Institute 2B, 2F, that's the end of the story. I would say it is very much up to the regulators to really think hard as to what they should do. And also, may I end on a Marxist note, the regulators of the world unite. Because if they do not unite, if they are very much at each other's throat, or if they want to outwit the other regulatory bodies in other countries or other regions, then the regulatory regime as a whole will fail. Thank you very much.
Thank you. We will all evidently read carefully the next speeches by Mervyn King to know whether there is a reference popping up to the certificate of immunity from death. Nicolas, I would like to give you an opportunity to respond before opening the floor to a question.
Very quickly and in telegraphic mode, on Anil's two main remarks. On failure dynamics, I think we absolutely agree. I cannot speak on behalf of Maurice, but I certainly agree with your criticism of Dodd-Frank and the contrast between the sort of moral imperative to punish the bastards and the stability imperative, and I think the legislation is clearly imperfect here, even so we know the political conditions which led to this outcome. The more difficult question, which you acknowledge, is how to address the problem you mentioned, and clearly here nobody has a clear response to this challenge at this point, which certainly doesn't mean there is none, but certainly that more work is needed. On bail-ins, you're absolutely right. I think in the final version of the paper we need to elaborate more on this, and partly it's because of well, I'm to blame for this delays in the preparation of the paper, but we'll work on this. For what Paul told us, you're probably right that we overdo the differences in the structure of credit intermediation between Europe and the US. The reason why we do it is that there is so little data available that can be put on a comparable basis, and basically I'll come back to you on to get more data. I wouldn't say we overdo the difference in terms of assets to GDP, which is perhaps our main argument. And it is, I think, an undisputable fact that the largest financial institutions in Europe are vastly bigger in terms of assets to GDP than the largest financial institution in the US. And I think this... to national GDP. And I think this is really our main argument. Of course, again, I repeat that we'd like to look at European GDP as opposed to national GDP, but that would suppose that you have a European policy failure, a framework to address banking failure, and even after the creation of the European Banking Authority, we're not yet there. I hope we're going towards this sort of framework. It's controversial, not least with the UK, but we're clearly not there. I think the point you made on what I would say resolution culture as opposed to supervisory culture is an extremely important one, and indeed it was sort of illuminating for me that clearly there is a resolution culture here in this country at the FDIC, probably more than in any other institution at the US federal level, and there is very little that is comparable in Europe. So we have to develop that. At the same time, and you mentioned that, we are not clear as to what this means for very large complex institutions, because the FDIC resolution culture very much applies to local retail or commercial banks, and the same framework applied to hugely complex international groups is very much untested. I also recognize that I didn't insist enough in my presentation, even so it is in the paper, about the intractable political nature of the cross-border resolution issue. And actually here we're saying that because it's so intractable, for the reasons you mentioned, we're very pessimistic about the progress that can be made on cross-border resolution at this stage, even in spite of the best efforts of Mario Draghi, of the FSB, and of many well-intentioned people in this discussion. I would, however, say that in spite of what I just said, I think the situation in the EU is slightly more promising than at global level. So I think we really have two discussions here. One is European cross-border resolution, where I would be mildly optimistic, and the other one is global cross-border resolution, where I'm definitely pessimistic. I think at global level we'll get more subsidiarization, more ring fencing, more locally capitalized and funded banking operations, at least in retail banking, and probably also to a certain extent in investment banking. I hope we can avoid that in the EU, because I think the corresponding financial fragmentation can be harmful. And that's actually also what the IMF has said with their, I think, very good paper on EU cross-border resolution in the spring. I'm not going to comment on Victor Gao's presentation, because anything I could say would break the charm, and I cannot be at this level. I'll just mention that the Guangdong International Trust and Investment Corporation is indeed a fascinating case. We make a very brief mention of it in the paper, and I fully support what you said about the fact that in this, as in other regulatory issues, we Westerners have to recognize that the Chinese or other emerging countries led the way and did better as for loan-to-value ratios or other things that can seem quite simple, but that the West generally failed to achieve, that we have to learn genuinely from the experience even of countries which by many measures have a less sophisticated or less developed financial systems, at least for the moment, than in the case in the North Atlantic. Thank you very much.
Thank you, Nicolas. The reason why I made this point about national GDP versus European GDP is because when you referred to too big to fail, you referred to the shock and the implication, the financial implication of the shock for the financial market, to the extent that banks are increasingly integrated, that the EU GDP that matters. And so basically what you're saying is that, in fact, it's maybe not the banks that are too big, that the states that are too small. Which is a slightly different point. Okay, I open the floor. I see Rajiv first, and Bill. Rajiv and Bill.
Thanks, John. Actually, on the too big to fail, first point is that I think absolute size of banks matters, not in percentage, not in relation to the GDP, because these banks are also operational in a lot of small countries, where they're really like a gorilla in the sort of room, rather not just small. So actually, so therefore, to think of U.S. banks being in some sense smaller and therefore having less systemic impact is, I'm not sure whether, where we are going on that. So that's the first. Second, I sort of speak now really as a member of the Warwick Commission, which had made several recommendations. Unfortunately, I don't find many, echoes of that. First one, and the only thing that I found was an Anil's recommendation on holding back bonuses and the bonus pool, because we made a recommendation saying that it's critical to change incentives for the players who are actually operating these banks. It's not products, it's not size, it's not banks, nothing. It is the agents who, how do you change behavior and incentive structure for that? I found so far very little in that regard, and I think they're, very a regime of pro-cyclical, counter-cyclical capital, requirements, not just large capital requirements, but counter-cyclical ones, was I think a good idea, but I don't know what's happened to that. Second, we had recommended that there be firewalls within the different sort of, financial institutions, so that no financial super mall, no sort of, is permitted to come about, and risks gets allocated to those who can manage those risks better. There is, credit risk, market risk, project risk. Why not sort of let that be handled as it was earlier? And the third thing is that the peer review mechanism. What are the incentives to enforce those decisions? We had suggested a name and shame thing, because there will be national jurisdictions, as they were in the past, which will find it convenient to have a race to the bottom, and then liberalize. And then what? So it's all very well to have these peer reviews, but then do we end up, where do we end up if somebody decides that it doesn't matter, they will not accept the peer review's decision? And my last point is to wonderful speech, intervention by Mr. Gao. There does seem to be some immortals and some mortals, like the 4 banks, which you have recapitalized successively, and starting off there, and they seem to have a life of their own. Now, is it true, or is it that they will themselves they will not be TBTF?
Bill? Then we come back to
No, go to the mic right here. I'd be interested in the panel's diagnosis of whether the TBTF problem is primarily distorted incentives or simply externality of a big entity. I mean, I think the fact that the key players who make the decisions in any corporation typically tend to hold stock would suggest, and since when a crisis arises, you basically get the stockholders being, even take Citigroup, their stock basically went to zero. I would have thought that the incentive argument is overdone. And the real problem is the social externality. So that the challenge becomes more, like you regulate wide-bodied aircraft, airlines more than you do, small passenger planes. It's just bigger fallout from the collapse. Now, to the extent that's not true, it seems to me one could do things to the incentives to make sure that the decision makers really are interested in the stock price, such as making all bonuses be paid in stock and only available after 5 years or something like that. But I'm not sure that this perception, in fact, I guess probably this perception isn't very widely shared. So I'd be interested in and I don't want to invite a long panel discussion, so let me ask Neil to see if he would perhaps take or maybe Paul, take a position on this. If the problem is the wide-bodied aircraft problem, then it's a very different kind of thing that you do. I think you have to you get more into Simon Johnson's kind of thing and Morris Goldstein's. Oh well, no bank can be more than 5% or 10% of GDP because you've done a cost-benefit analysis and the return to size is tails off there. So I don't know. I'd be interested in whether this sparks any particular insight to the problem.
The taxpayer loses is still a problem that's not going to be solved by paying more with stock-based compensation. So I understand that, but if we have to bail out a bunch of other people and if they de-lever and have a fire sale and it crashes the economy, the mere fact that they got wiped out isn't enough in my book. So that they can impose risks and costs on society beyond just the direct losses associated with the equity. So I think you have to think about two things here. I think you're right that the externality of the failure is what you're trying to control, and I think you want to figure out ways to mitigate that. But I think of the holding back of bonuses as a way to get them to feel like they should issue equity and risk a little bit of dilution or bail-in or any of these other things are incentives to get them to realize that just shrinking assets and trying to race for the door is not collectively what the country wants. I mean, I think it's a big problem that all our regulation is in terms of a ratio instead of dollar values. And I think one of the things that the stress test did well was not leave on the table the option of beating the stress test by shrinking your assets, by basically telling them you had to raise a certain dollar amount of capital. So you can shrink if you want, but that doesn't force you to actually go get the capital. Was a very clever thing that's been underappreciated. And that's because the capital buffer is what protects the taxpayer.
I would add to that. It's striking this debate about incentives or remuneration is always cast in terms of how much equity they should get, which of course does give them the downside, as you rightly described, but it gives them a lot of upside as well. It might be different if they were paid in debt or subordinated debt in part. And this then relates to the resolution debate, because that is only credible if it becomes possible to impose losses on debt holders or indeed subordinated debt holders. But if they were holding 5-year or 10-year subordinated debt or just senior unsecured debt, they would have an interest in preserving the solvency of the firm. I don't mean for all of the remuneration package, but for part of it. But more generally, I agree with you that it's more about the externality of the failure than about incentives.
Allow me to answer your question very briefly about immortals versus mortals, especially among the 4 major state-owned commercial banks in China. While I'm not here to defend or justify the regulatory system in China, one thing I want to say is that it is very different from the model in the United States or Europe. Let me give you one example. You know, Mr. Wang Qishan, who is right now Deputy Prime Minister in charge of financial and foreign investment in China. He's the head of the Chinese delegation in the strategic and economic dialogue with the United States. When he was the governor of China Construction Bank, one of the 4 largest commercial banks, in a very small setting, and I was present at that time, he basically said, whenever I meet with the provincial branch governors, I always presume that they are the wolves who are waiting to prey upon you. And you cannot let down your guard. And whenever you shake hands with them, when you take back your hand, you need to check how many fingers you have. So this is the kind of presumption against rogue bankers, or some of which were your principal subordinates. And I think in terms of the regulatory philosophy, the rigorousness, the hands-on attitude and the discipline, and also the presumption of the evils, for example, among the operatives, for example, and also the anticipation of the problem, the lack of this laissez-faire attitude towards the banking or the insurance or the securities market, and also the sense of urgency and the eagerness to always second-guess the market practitioners. For example, before the collapse, before the outbreak of the financial crisis, Bear Stearns almost got to merge or tie up with CITIC Securities. CITIC Securities were very, very eager to proceed with that deal. What caught it up was the slowness in the regulatory approval. And after the dust settled, everyone congratulated themselves. And the CITIC really felt so lucky that they actually were not burned as Ping An Securities in the Fortis deal. Now, I make this a point in the hope that while the different countries, etc., may have very different regulatory philosophies, and it is fully understandable, and I'm not advocating any country to simulate or to copy the Chinese regulatory system, which can be very oppressive, but it is very, very important to compare notes and to learn from each other and really to draw upon the good examples, because I think there is the tendency that the Wall Street forces are really getting too much of a force, and they sometimes can hijack the regulatory system, and also they can hijack the whole countries, for example, and eventually the taxpayers need to pay, and eventually, as we witness in some of the European countries, it's even beyond any single country's capability to repair the damages which may be inflicted upon by these rogue companies or traders.
Can I? Just one point on Rajiv raised about the counter-cyclical stuff. I thought almost everything Mario said was great, but one thing that scared me is he kind of said, well, if these guys aren't at the discount window, we're not going to chase the shadow banks, so there's a limit to how far we can go. One point that rarely gets made is if you implement counter-cyclical policy, so you're trying to slow down the lending during the boom, of course that raises the incentives during the boom to move stuff to the shadow system, and that's exactly the time when the shadow system's financing constraint is easiest, and it's easiest to move there. And so while I think countercyclical regulation of some sort, it's a good idea. If you're not going to chase the stuff into the shadow banking system, you're going to perhaps make things actually worse or more pro-cyclical.
Okay, I think Paul wanted to make one, but I then back to...
Can I just add to that, and actually particularly a point about the UK. In the UK, we are moving towards a regime where we will do counter-cyclical stuff, but we're also, the regime that our new government is planning will give the Bank of England the obligation of recommending to the finance ministry when the perimeter of regulation should be changed. I mean, and that's the kind of, it's that, you know, that doesn't solve everything, but it seems to me to be a necessary condition for solving this shadow banking problem, to recognize it and give someone the responsibility of not just monitoring the whole, but of changing where the perimeter is. The other thing I wanted to pick up, if I may, was what you said about peer review, because essentially you challenged whether this is going to amount to anything, and I understand why you do that. I'm reasonably optimistic on this, because our incentives as countries is to be completely candid with each other about these global SIFIs. The small banks don't matter very much, frankly. They're cross-border. They don't screw up our economies. Whereas the really massive institutions from my own country, from America, from Germany, France, if the regimes for these countries are poor, we have no incentive not only to not address that with the other countries, but actually in our case to go to Parliament and say we're bothered about this and we can't solve it directly, but we want you, the people of our country, the representatives of the people of our country, to know this. And as the reforms go through in the UK, I think that our mindset will be to be as transparent about our concerns in this area as we've become used to being in the monetary policy area.
It's good to probably write it down, because there was an FSA before the FSD. This sort of thing can happen, presumably, but nothing came out. So it's probably good to kind of codify that, what with the transparency you just mentioned.
Yeah.
Okay, can I give the floor to Nicolas and then we go back?
A few short annotations. On the shadow banking system, I think there are two very different things when we speak about the shadow banking system. And they don't mean the same in this debate about too big to fail. One is about weakly regulated or unregulated autonomous financial institutions like hedge funds or others. And here the experience of the crisis is mainly that they were not the ones that created the problem in this crisis. They may create the problem in another crisis. LTCM was serious enough. But in this crisis, they weren't the place where the risk came from, unlike the consensus in the regulatory community just before the crisis. I remember the conferences in early 2007, about risk exercises, etc. It was all about hedge funds. The regulatory community was entirely wrong on this risk identification, and I think we should remember that. Now, there is another part of the shadow banking system, is all the off-balance sheet vehicles, the SIVs, the ABCP conduits of German Landesbanks, etc. And this is what has proven particularly harmful in this crisis, and it's absolutely relevant to the too big to fail discussion, exactly the way Anil mentioned it. We don't want regulations to incentivize large financial institutions to shift the number of risks of the balance sheet, and it's not just an accounting problem, I can tell you, in a way that makes them, in practice, retain the risk while not showing it. So I think this latter shadow banking system is really what you want to address in this discussion, rather than hedge funds or other autonomous unregulated or weakly regulated financial institutions. Even so, you may want to regulate them more as well. As to the last words of Victor Gao's last intervention on capture. I think one of the things we try to explain in our paper is that yes, the capture of the US political system by Wall Street has been very well documented and criticized, and Simon Johnson here at the Institute and Maurice also have been instrumental in this. But the fact that you don't see it working the same way in Europe from European banks doesn't mean that you don't have parallel phenomena of capture. And I think this may be at least intuitively evident to all the Europeans in this room. It may not be evident to all the Americans, because there is a way of measuring capture in this country which is linked to a certain degree of transparency of the public system, where you measure, lobbying expenses, campaign contributions, that sort of things, and you don't see the same things in Europe, partly because they don't work the same way, partly because they're not disclosed the same way. But that doesn't mean that capture is less real, and I would actually argue that in line with the sort of numbers I showed about assets to GDP in a number of continental European countries, you have a systemic importance of banks which is not only financial but also political, that is certainly not at lower levels than what you see in the US. So I think this comparative perspective is perhaps something that has to be brought more into the debate, even so it's intrinsically controversial. On Bill's point, I agree. I think it's about the externality of large institutions primarily, and that's why we didn't discuss remuneration that much in the paper. The other reason, and that also is to Rajiv, is that we really tried to focus on issues that were specific to too big to fail. We didn't try to focus on issues of financial stability that apply to all financial institutions. We really wanted to see what is specific to the big ones. Because we wanted to have focus in our paper. We didn't want to have just another paper that goes across the whole range of issues in the crisis, and that means that purposefully there are a number of very important dimensions of the regulatory debate that we don't address at all in the paper, because we really wanted to have a paper on too big to fail. For example, we don't address contracyclical capital buffers. It's a very interesting debate, but we don't think it's something that's specific to too big to fail. Last thing about peer reviews. I'm with you on peer reviews. I'm among the skeptics, and actually we have another piece of research with Belgian co-author Stéphane Rottier at the National Bank of Belgium, which was published a month ago both by Bruegel and by the Institute here, that tends to suggest that it's difficult these days to get things done at global level, actually more difficult than before the crisis, in spite of all the political impetus at G20 level. And we explain why, or we try to explore why in the paper. One thing we find is that if you want to get things done in the current environment at global level, you better have strong global institutions. You better have institutions at global level that have some autonomy of resources and of initiative. And we have actually numbers on this. We analyze the outcomes of the first G20 summit decision, so 39 measures on financial regulation, and we looked at what happened about them, and the correlation is extremely clear, even clearer than we expected to find. That, the stronger the institutional framework at global level in terms of autonomy of resources and initiative, the more things get done. So this is a bit controversial, because then, institutions compare themselves and they say, well, this is unfair to us, etc. But actually the evidence is there.
Okay, I'd like to give everyone 5 minutes before the next panel resumes. So maybe there was a question here. Please ask your question. Can you be quick? And then we go back to the panel and close.
Yeah, I'll be quick. I know the focus is on too big to fail, but there's a related issue that intersects. There's a related issue that intersects, and it's the too complex to manage, too complex to regulate, too complex to bail out, or too complex to insure. I know that wasn't the subject of this panel, but I wonder if the panelists might comment on that and the extent to which those complexity issues intersect with the size issues.
It's fair to add this dimension. Who would like to respond? Paul?
It's absolutely part of this agenda. You're completely right. I would say 2 or 3 things about it. First of all, to the extent that we can make it credible, and I promise you, the official community is completely determined to make it credible that we will put losses on unsecured, uninsured debt holders. That will bring market discipline back into this part of capitalism. It is shameful that finance, which is at the heart of capitalism, doesn't proceed according to the precepts of capitalism. And market discipline, I think, over time would reduce the degree of complexity. Second thing I'd say is we need to look at large exposures regime. This is the kind of so-called network problem. Not only do we tolerate quite large exposures between medium-sized banks, 10%, 25% of capital, that also goes for the largest and most complex institutions in the world. and arguably we should limit their exposures to each other to levels much below that, which is starting to be debated in the many committees that gather in the Basel Tower. And the third thing is that the things like central counterparties will bring some simplification of the network. I doubt it will be enough, but when we see the results of that in a few years' time, we'll be able to see what residual complexity we have. And I don't think that the energy to deal with this is going to dissipate very quickly when unemployment remains around the Western world at uncomfortably and tolerably high levels, so that we can proceed in stages, and the determination in the official community is quite remarkable.
Just to say briefly that complexity is at the core of the topic. It's a mix of size, complexity, systemic relevance, etc. We discussed this in the paper. I'll just mention that a related debate that we don't really address in the paper, but which is sort of at the boundary of this issue and other issues, is the debate about functional separations in financial conglomerates, what you had alluded to, Rajiv, on supermarkets and things like that. And you can see through a Toobigtofail lens that a financial supermarket is too complex and creates this sort of systemic risk, or you can see it through a different angle, typically what you alluded to in terms of allocating different categories of risk to different financial institutions. And because we thought it was at the boundary, we didn't discuss it very thoroughly in the paper. But this, in my view, basically what you could call simplistically the Glass-Steagall debate, but in the 21st century and at global level with international implications, this debate is not going to disappear. In Europe, policymakers are doing, most policymakers, perhaps not in the UK, are doing everything they can to avoid having this discussion, but I don't think they will avoid it.
Okay, thanks to all the panelists for the discussion. We now break for 5-10 minutes maximum and resume.